This week, data showed that U.S. inflation had dropped to 5% on an annual basis, continuing a 9-month streak of declining inflation. But that number was still well above the 2% target. And this comes after the collapse of several regional banks, the fallout of which leads Fed economists to believe the economy will tip into a mild recession later this year. Where is this all headed? I sat down on Friday for an exclusive interview with Treasury Secretary Janet Yellen. Madam Secretary, thank you for joining us.
Thank you for inviting me.
Let's talk about the American economy.
Sure.
The Federal Reserve has raised rates at some ways at a faster pace than almost, ever before. And yet, America remains at full employment. I mean, in general, the argument is the way you crush inflation is you raise interest rates, make it harder for people to borrow, which then causes the economy to slow down, unemployment to rise. But unemployment really isn't rising. One of your predecessors, Larry Summers, says you're going to have to get unemployment up to really break the back of inflation. Do you think that you're going to need to see substantially greater unemployment before inflation is conquered?
I think we probably need some easing of stress in the labor market to get inflation down. But that doesn't mean that we need to see unemployment rise significantly. I believe a strong labor market and bringing down inflation are compatible goals. And I think we're seeing that play out right now. First of all, inflation is too high. And President Biden and I feel this is a primary problem that is afflicting American households. And it's something that we need to deal with. The Fed has the primary role here. We're trying to do other things that we can to be supportive, but it is a problem. But it has come down significantly. It's been declining for a number of months. And we continue to create jobs at a remarkable pace, over 230,000 jobs last month. So the labor market remains very strong, but we're still seeing, with a slowdown in the economy, something we expected and is natural given that the economy is operating at full employment near its capacity. We're seeing some easing of stresses in the labor market. Initial claims for unemployment insurance, they're not at levels signaling distress, but they have risen somewhat. Job openings have declined somewhat. Wage growth has still solid, but has moved down somewhat. And labor force participation has moved back up. It declined substantially when the pandemic struck.
But so you think you can achieve what people are calling this immaculate slowdown, where you slow down the economy enough to cut inflation, but not so much that it throws a lot of people out of work?
That's right.
I mean, mostly economists have often viewed this as a trade-off.
I think that what people call a soft landing is possible. So I do think there's a path to bring down inflation while maintaining what I think all of us would regard as a strong labor market. And the evidence that I'm seeing suggests we are on that path. Now, are there risks? Of course. I don't want to downplay the possibility that there are risks here, but I do think that's possible. There are many factors that have been pushing inflation up that have nothing to do with the tight labor market. Russia's war on Ukraine raised food and energy prices. The disruption from the pandemic caused supply bottlenecks that led to outright shortages, pushed up, for example, the prices of cars dramatically, new and used cars, because of shortages of semiconductors. We're seeing those supply chain bottlenecks that boosted inflation. They're beginning to resolve. We had big shifts in the way people live. and low interest rates, and housing prices rose a lot. Now housing prices have essentially settled down. Rental prices of new rental units moved up a lot, but they've now settled down and are falling. And that's an element of inflation that will continue to subside over time.
What effect do you think the SVB bank and the sort of banking crisis, if one calls it that, has had on this program? Lloyd Blankfein, the former CEO of Goldman Sachs, said he thought it had the equivalent effect of the Federal Reserve raising rates, meaning that banks everywhere were now being careful, being cautious, not lending a lot of money, and that therefore it was also going to slow the economy down and slow inflation down.
So I want to say we took rapid action to deal with the failure of two banks that had rather idiosyncratic features that caused them to fail, wanting to make sure that Americans feel safe about their deposits. And what we've seen in the aftermath of those actions is that outflows from the banking system have stabilized and things have been calm. We're, of course, monitoring things carefully, but I think the actions that we've taken have stemmed the systemic threat that existed because of the failure of those banks. Banks are likely to become somewhat more cautious in this environment. We already saw some tightening of lending standards in the banking system prior to that episode, and there may be some more to come. And that does tend to lead to somewhat greater restriction in credit that could be a substitute for further interest rate hikes that the Fed needs to make. But I'm not seeing anything at this time that is dramatic enough or significant enough, in my view, to significantly change the outlook. So I think the outlook remains one for moderate growth and continued strong labor market with inflation coming down.
Next on GPS, I'll be back with more of my interview with Secretary Yellen. We will talk about Russia sanctions and aid to Ukraine, and whether there will need to be more of both. Finance ministers from around the world descended on Washington this week, as they do every spring, for annual meetings of the World Bank and the IMF. They gather at a worrying time for the world economy. The IMF said this week that it expects global growth to be slower than last year, only 2.8%. One of the pressures weighing the world down, of course, is Russia's war with Ukraine. More now of my exclusive interview with Treasury Secretary Janet Yellen. You must, at these IMF meetings, be talking about the Russia sanctions. And I wanted to ask you, when you look at them, what is the piece of evidence you could point to that conclusively demonstrates that they are actually working and that Russia is being substantially deprived of revenues, that Putin is paying an economic price?
So we've had two objectives from the outset. One is to deprive Russia of revenue, as you noted, and the second is to deny him access to the equipment that he needs to provision his military adequately to conduct this brutal war. On the revenue side, our price caps that we've put in place on Russian oil have lowered the revenues that Putin is receiving by roughly 40% over the last year. He expected to have budget surpluses. He now has very large budget deficits. In terms of equipment, we know that we've had great success in depriving him of the equipment that he needs to conduct this war. This is due to our export controls and, importantly, it's not just the United States acting alone, it's that we have a strong coalition, partners who are working together to put in place sanctions, export controls, and working jointly on enforcement. He lost over 9,000 pieces of heavy equipment on the battlefield, and we see the Russians struggling to replace this. So we see on the battlefield, Russia is now forced to resort to Iran and North Korea to try to supply his military, and we continue to take steps to make sure that evasion of our sanctions isn't possible. But we think his military is really short of the equipment that they need to wage war.
Let me ask you about one of the costs or one of the prices of these sanctions. The way that the United States has used sanctions often, in this case, in the case of the Iran nuclear deal, is to use the power of the dollar as the reserve currency of the world. But that weaponization of the dollar has produced a reaction. This week, President Lula in Brazil said, why are we all being forced to use the dollar? Emmanuel Macron made reference to the dollar in that same way. The European Commission has talked about, after Trump pulled out of the Iran sanctions, talked about creating an alternative to SWIFT, to the American-dominated payment system. Is there a danger that we will look back at all this, these measures and say this was the moment that the dollar's hegemony and its status as a reserve currency began to falter?
So there is a risk when we use financial sanctions that are linked to the role of the dollar, that over time it could undermine the hegemony of the dollar, as you said. But this is an extremely important tool we try to use judiciously and in circumstances, especially when we have the support of our allies. It's not just the United States. It's a coalition of partners acting together to impose these sanctions. So it is a very effective tool. Of course, it does create a desire on the part of China, of Russia, of Iran to find an alternative. But the dollar is used as a global currency for reasons that are not easy for other countries to find an alternative with the same properties. The U.S. Treasury market is the deepest and most liquid and safest asset. Dollars are widely used. We have very deep capital markets and rule of law that are essential in a currency that is going to be used globally for transactions. And we haven't seen any other country that has the basic infrastructure and institutional infrastructure that would enable its currency to serve a role like this.
Let me ask you one question about Ukraine, about rebuilding Ukraine, resupplying it. It's going to take a lot of money.
Yes.
There are some who say this money should be taken from Russia's frozen central bank reserves. Would you agree with that?
I think Russia should pay for the damage that it has done to Ukraine. So that's a responsibility that I think the global community expects Russia to bear. This is something we're discussing with our partners, but, there are legal constraints on what we can do. We have frozen Russian assets, and we're discussing with our partners what might lie in the future, but I think that's the right thing to happen, that Russia should pay for the damages that it's caused.
Janet Yellen, a pleasure to have you on the program.
Thank you, Fareed.
Next on GPS, the leak of American classified documents. What effect will it have for U.S. relations around the world and on the battlefield in Ukraine?